Market Recap. I'm Daniel.
And I'm Mira.
Imagine you owe $40 trillion.
That is a lot of zeros.
Right. And now imagine the very people you rely on to pay your interest are, simultaneously threatening your energy supply.
Oh, and attacking your agricultural logistics.
Exactly. Plus, they're actively hiking your borrowing costs. So, welcome to the U.S. economy today. We have got a massive deep dive for you all.
Yeah, if you have been watching the screens, you already know the day's dramatic price action. U.S. equities are sliding dangerously close to their monthly lows.
The 10-year Treasury yield is just marching steadily higher, and safe haven assets like gold and crude oil are absolutely spiking.
Which is wild to watch.
It really is. So we are going to give you the complete breakdown of exactly what is happening. We are covering the synchronized overnight geopolitical shocks, the U.S. economic data that drove bond yields higher.
Recap of today's corporate earnings.
Yeah, and of course our daily paper trading segment at the end.
But real quick, before we jump into those details, a quick reminder. This deep dive is for market context and discussion only.
Right. It is not personal investment advice or an investment recommendation.
Exactly. We are just here to help you understand the baseline you are operating against, not to tell you how to trade.
Well said. Okay, so we have to ask, what set the stage before the U.S. session even began? Because to understand today's price action, we really need to look at the macro backdrop.
Right. The baseline coming into today was already incredibly tense. You have a highly hawkish Federal Reserve bias and, like you mentioned, the gravitational weight of a staggering $40 trillion U.S. national debt.
Which is heavy enough on its own.
For sure. But then we had this series of synchronized overnight geopolitical shocks that just completely rewired the risk landscape.
The board really lit up overnight. Let's start with the Middle East. At 7 p.m. Eastern Time on August 19th, President Trump announced an unprecedented economic pressure campaign.
Right, and the stated goal here is to isolate Iran and impose severe consequences on any nations providing financial assistance to Tehran.
Yeah, and we are expecting more clarity on the mechanics of that soon, with Treasury Secretary Scott Bessent scheduled to hold a formal press conference on this on Monday, August 24th.
And unsurprisingly, Iran's foreign ministry has already swiftly rejected the campaign.
Look, as always, we are just looking at the facts and the market implications here. We maintain strict political neutrality.
Always. But I mean, the market implication is undeniable, right?
Yeah.
Is a severe ratcheting up of tensions.
And those tensions aren't just, theoretical policy documents. They are physical. Almost immediately, at 5:50 a.m. Eastern Time on August 20th, we saw an armed seizure of a commercial oil tanker in the Gulf of Aden near Yemen.
And that hijacked vessel was reportedly steered towards Somalia.
Right. And the U.S. military responded by deploying the USS George Washington to the Arabian Sea. Plus, at virtually the same time, Yemeni drone strikes targeted Saudi Aramco facilities.
So you were looking at direct physical threats to one of the world's most critical energy transit corridors.
But it wasn't just the Middle East. Moving over to Eastern Europe, there were major Russian missile strikes on Kyiv at 5 p.m. Eastern Time on August 19th.
But crucially, also on Black Sea logistics hubs, specifically Kornomorsk and Pivdeni.
Right, and the immediate projection from Ukraine's agriculture ministry is that these port disruptions threaten to spike global wheat prices by $80 a ton.
Which is massive.
It is. But I have to push back on the prevailing narrative here, though. There is this natural reflex to view geopolitical events like unpredictable natural disasters, like an earthquake that just randomly shakes the market.
Right, just bad luck.
Exactly. But I want to challenge that. How should we actually interpret this timing?
It is a really great question, and you really have to view this through the lens of geopolitical escalation as game theory brinkmanship.
Because these synchronized escalations are rarely random chaos.
Right. I mean, energy infrastructure in the Middle East, agricultural logistics in the Black Sea, and broad economic sanctions, all converging within a roughly 12-hour window.
It is too perfect.
Exactly.
Yeah.
When you apply that game theory lens, you stop reacting to headlines as isolated accidents and start seeing them as calculated leverage.
You have to wonder if these moves, happening right ahead of a major U.S. Treasury press conference, are strategic pressure points meant to test Western resolve.
Which creates a terrifying prospect for the market. It is a classic supply chain shock, acting as a multi-channel margin tax, where both energy and food prices are squeezed simultaneously.
So overnight, this geopolitical leverage creates immense supply chain anxiety. When the opening bell rings in the U.S., the market is desperate for some reassurance that the domestic economy is stable.
Which brings us to the next big question. We are going to take a really quick break, but when we come back, we will get into exactly how the market digested all of this.
Don't go anywhere.
All right, we are back. So what moved markets during U.S. trading hours?
Well, the intraday moves were just violent. S&P 500 futures fell from an overnight high of 7,746.50 and just bled out to close at 7,667.
Wow.
Yeah. And the 10-year Treasury yield, which is the benchmark for pretty much all borrowing, rose 4.3 basis points to 4.696%.
And meanwhile, the safety trades were just screaming. Gold staged this massive headline-worthy reversal, surging to $4,575.60.
And WTI crude spiked to an intraday high of $87.69. But help me understand the mechanism here. Why are gold and crude oil the specific assets spiking?
The crude oil is a more straightforward one. When you have armed hijackings in the Gulf of Aden and drone strikes on Saudi Aramco, you have a direct physical threat to the supply chain.
So the market immediately prices in a risk premium for potential oil shortages.
Exactly. Gold, on the other hand, is acting as a gauge for systemic safety and credit stress. When inflation fears rise because of those oil and wheat shocks and geopolitical trust breaks down, institutions buy gold as a hedge against fiat currency volatility.
That makes total sense. So we have this geopolitical fear, and then the U.S. economic data hits in the morning, and it completely throws jet fuel on the fire.
Oh yeah, at 8:30 a.m. Eastern Time.
The Philadelphia Fed Business Index saw a massive, undeniable beat. It surged to 47.4 against a forecast of just 24.75.
And at the same time, initial jobless claims fell to 206,000.
So manufacturing is surging, and people are staying employed. I have to admit, I am a bit lost on the market's reaction here.
How so?
Well, if jobless claims are dropping and manufacturing is up, that means the economy is fundamentally healthy, right? People have jobs, factories are making things. Why is Wall Street punishing stocks for good news?
It is the ultimate good news is bad news paradox. The market is not selling off because the companies are weak. It is selling off because a strong economy means inflation might stay sticky.
Because if consumers have money and keep buying things, prices do not come down.
Right. And if prices do not come down, the Federal Reserve cannot cut interest rates. And this brings us back to that classic idea of risk-free yields as gravity-compressing equity multiples.
Ah, right.
Think of the 10-year Treasury yield like financial gravity. When that yield gets heavier when it goes up, it physically drags down the valuation multiples of high-flying stocks.
No matter how good their underlying earnings actually are.
Precisely.
Because if an investor can get nearly 5% completely risk-free from the U.S. government, they are going to demand a much higher return to take a risk on a tech stock.
Exactly. And that economic resilience absolutely emboldened the hawkish voices at the Federal Reserve today. St. Louis Fed President Alberto Musalem delivered a stark warning on CNBC at 11:28 a.m. Eastern Time.
What did he say?
He pointed out that underlying inflation at 2.5 to 3.0% is simply uncomfortably high.
Yeah, that is definitely above the target.
He even argued that current policy is actually neutral or accommodative, and suggested that hiking rates now could save more aggressive action later.
Hiking rates, not just holding them steady, but actually suggesting more hikes. Though we did get a slightly different flavor from San Francisco Fed President Mary Daly earlier, right?
Yeah, at 8:26 a.m. Eastern Time. She noted the labor market is showing what she called uncomfortable stability.
Uncomfortable stability. That is quite a phrase.
Right. She acknowledged the Fed is missing its inflation goal by quite a bit, but she sounded far less eager to preemptively hike.
True, but the overall posture remains heavily restrictive. It feels like central bank paralysis under supply-driven stagflation. And you have to contextualize this monetary policy with what is happening on the fiscal side.
Oh, definitely.
Because just the prior evening, August 19th at 4 or 5 p.m. Eastern Time, Treasury Secretary Scott Bessent was talking about increasing debt buybacks to over $4 billion.
To support the $40 trillion debt market.
Let's unpack that because it sounds counterintuitive to a lot of people. The government is deep in debt, issuing more debt constantly. How does the government buying its own debt actually help anything?
So think of the Treasury market like a massive multi-lane highway system. Older bonds, which investors do not trade as often, are like cars stalled in the middle lanes.
They are moving, and they're blocking the flow of traffic.
Exactly. So the Treasury stepping in with buybacks is like sending a fleet of tow trucks. They use cash to buy up those older stalled bonds from dealers, clearing the lanes.
And now those dealers have fresh cash in hand, so liquidity can flow smoothly again into the new, highly liquid bond issuances.
It lubricates a $40 trillion market that might otherwise freeze up under the pressure of these high interest rates.
That is a brilliant way to picture it. They're just clearing the financial plumbing. Okay, let's take one more quick break. When we come back, we will look at how individual companies handled all this gravity.
See you in a minute.
And we are back. So, what were the standout corporate moves today, and what should we watch next?
Well, we have to start with Walmart. At 5:33 a.m. Eastern Time, they reported a very strong Q2 earnings beat.
Walmart basically acts as the ultimate proxy for the U.S. consumer.
Right, exactly. This earnings beat proves that domestic retail demand remains incredibly resilient, despite all the inflation pressures we were just talking about. Consumers are fully employed, and they are still spending.
Even with fears of consumer debt exhaustion bypassing rate cut relief, they are still buying. Meanwhile, on the completely opposite end of the spectrum from retail groceries, we have the artificial intelligence boom.
Right. At 9 p.m. Eastern Time, news broke that Broadcom is seeking over $60 billion in debt financing for AI infrastructure.
$60 billion. And here is the interesting part. This is being backed by private credit giants like Blackstone and Apollo. Why are they going to private credit for this? Why not just go to a consortium of traditional megabanks?
It really comes down to regulatory agility and scale. Traditional banks are like large commercial airlines. They are highly regulated, they have fixed routes, and strict weight limits on luggage.
Which, in the banking world, translates to capital requirements that cap how much they can lend to highly leveraged entities.
Exactly. Private credit, on the other hand, is like chartering a private jet. They use pooled capital from institutional investors, so they aren't bound by those same banking regulations.
It's faster, and they will structure a bespoke, massive loan exactly how Broadcom wants it.
But they are going to charge a premium for the ticket.
Which perfectly highlights the dynamic of AI capital expenditures acting as a self-referential valuation loop. The tech sector is essentially funding its own revenue growth through historic levels of debt issuance.
Not to mention AI power demand acting as a physical grid bottleneck, making all this infrastructure even more expensive.
Yeah, the costs are just astronomical. And speaking of the tech sector, we also got a bit of cold water on the chip market today. At 12:59 p.m. Eastern Time, NVIDIA officially shut down rumors that they were developing a China-specific LPU chip.
Which is a stark reminder of the ongoing geopolitical ceiling on semiconductor markets.
But wait, what exactly makes an LPU different from the GPUs we always talk about? And why would China need a specific one?
Well, GPUs, or graphics processing units, are amazing at parallel processing, doing a million simple calculations at once, which is great for graphics and general AI training.
Okay.
LPUs, or language processing units, are a newer architecture specifically optimized for the sequential nature of large language models. They process text tokens much faster and more efficiently.
Ah, I see. And China would want a specific, slightly detuned version because the U.S. has strict export controls on advanced semiconductors, right?
Right. NVIDIA has to constantly engineer chips that are powerful enough to sell, but just weak enough to slip under the U.S. regulatory radar.
It is an incredible technological tightrope. Honestly, hearing about $60 billion in private credit debt makes me feel a bit better about my own credit card bill.
If today's market sell-off has you feeling like that hijacked tanker in the Gulf of Aden.
Just remember you are not alone in these volatile waters.
Right. On the bright side, with gold staging a massive rally to nearly $4,600, that gold-plated buy the dip mug on your desk is officially the top-performing asset in your portfolio.
Yeah, at least Treasury Secretary Bessent reassured us there is nothing magical about a $40 trillion national debt, which is exactly what I plan to tell my credit card company this evening.
Let's just hope the next Fed speaker remembers what a rate cut actually sounds like before our tech stocks slide any further.
Ring that bell, take a deep breath, and we will ride the waves again tomorrow. Okay, let's look ahead. Here is what you need to watch over the next 24 hours. Tonight at 9:15 p.m. Eastern Time, we have the China August loan prime rate fixing.
And then moving into Friday At 2 a.m. Eastern Time, the UK July retail sales drop.
Followed closely between 3:15 and 4 a.m. Eastern Time by the flash PMIs for France, Germany, and the broader Euro area.
And the big one for the U.S. hits Friday morning at 9:45 a.m. Eastern Time. The U.S. S&P Global August flash PMIs.
Also keep in mind, all session long on Friday, we have the monthly U.S. equity and ETF options expiration,
which always injects some structural volatility into the mix as market makers act as shock absorbers and liquidity amplifiers to hedge their exposures.
Always a wild day. Now, before we move to our paper trading segment, I want to leave you with a provocative thought to mull over. We have talked about Broadcom borrowing $60 billion at high private credit rates. We have talked about Walmart showing the consumer is still spending heavily.
It is quite the contrast.
If corporate capital costs are reaching generational highs to fund AI infrastructure, while consumer spending remains remarkably robust despite inflation, who ultimately breaks first?
Is the heavily indebted tech sector choking on its own capital costs? Or is it the fully employed but inflation-weary consumer where cyclical demand is the next domino to fall?
It is the ultimate tension in the market right now, and navigating that exact tension is why we run our internal paper trade